Let's talk about mortgage discount points. So, first of all, let's establish what it is and what it is not. So, the word points is just a generic mortgage term anyway. A true point, like 1 point, equals 1% of a loan amount. So, if a loan amount is 400 grand and somebody pays 1 point, that means at closing they would pay $4,000, 1% of that $400,000. So, that is a point. When people say, I don't want to pay points, points can mean just generically, I don't want to pay points, meaning a percentage alone, because you could have half a point, you can have a quarter of a point, you can have any number fraction, you can have multiple points, 2 or 3 points. So points is just a fancy way of saying a percentage of the loan amount when it comes to getting a mortgage, right? So if somebody pays points or doesn't pay points, first of all, what are points, right? So it's the discount point. So there's a in the old days. So if you're talking to somebody from having done loans in the 90s and the early 2000s, they would say an origination point is technically different than a discount point. Back in the old, when I first started in the business back in '03, points were kind of just this like gray area. It could have meant anything. Well, nowadays, origination point means it's paying the bank money. That's how the bank is making money, or the lender, whoever it is, right? So if an origination point, so if a bank charges 1 point of origination, so let's use the $400,000 example I gave you. That's 4 grand. That money is going to revenue to the bank. So that's what they're doing, and that's what they need and want to collect. That's part of their revenue. Good for them. If they're charging a discount point, and that's what we're talking about as far as this topic, right? We're talking about buying down the interest rate. A discount point is used, or at least connected to, the interest rate. So if somebody's paying a discount point, whether it's willing or unwilling, because sometimes rates and programs make it to where you have to pay this discount point. Like the market just doesn't allow you not to. That's a post-COVID thing. We see that more nowadays. But the reality is the discount points are in connection with the interest rate. So fundamentally, when you pay more points, when you pay that money at closing, discount points, you get the trade-off is you get a lower, better interest rate, or you get something better in your loan term. So for example, if an investment loan has a prepayment penalty, there may be an option to pay a discount point at closing to remove that prepayment penalty. So maybe the rate didn't move, but it improved the terms of the loan and what you're doing. So a discount point is connected to the loan terms. It's not revenue to the lender. The discount point, fundamentally at least, right? I can't speak how every lender does their business, but conceptually, the discount point is connected to the loan itself, if that makes sense. So origination point goes to lender, that's their revenue. Discount point somehow is applied to the mortgage itself. And so 1 point is equal to 1%. So, pardon me, when should you pay a discount point? When to pay a discount point, when not to? So let's say you do have the choice, right? Let's say where somebody's, we're going to just talk about a loan that somebody's getting and the rate is X. Well, they may have the option to pay 1 point and get X minus something like a lower interest rate than X. And so if they do that, you would think, well, man, that makes sense all day long. Well, maybe it does, maybe it doesn't. So if somebody were to pay, let's use 1 point and on this $400,000 mortgage, and they were to say, okay, I'll pay 1 point and that's going to be $4,000 at closing. Should they do it? Well, if they ultimately would save, let's say, $400 or say $500 a month, let's make it easy. And that'd be crazy. If 1 point saved you $500 a month, I'm just doing this for example purposes. But let's say it saved them $500 a month for whatever that difference is in rate. Well, if that $500 of interest is $6,000 a year, 500 times 12, that means if they only paid 4 grand for it, they make their money back in, call it 9 months. Because again, by the time it's 8 months. I'm sorry, that's easy math, right? So I did it. 8 months of $500 savings is 4 grand. So they essentially made their money back. The money they paid at closing, that 4 grand, they made it back in 8 months. Like that's a no freaking brainer. I will tell you, post-COVID, I don't see that break even anymore. Pre-COVID, when we did refinances and the way the market was and how things were structured, that wasn't uncommon. It wasn't common, but it certainly wasn't unheard of. Nowadays, that's not the reality. So nowadays, let's take the example of, let's say that more likely scenario is you pay that 4 grand, and now it's even a good case scenario would be $100 a month. So now that's $1,200 a year. Well, doing rough math, right? It's 3.5 year break even to justify paying that 4 grand at closing. How did I come up with that? $100 a month, $1,200 a year. After 3 years, that's $3,600. Add 4 more months to it. For the $400, it makes up 4 grand. So the 4 grand will be on month 40. So again, call it 3 years and 4 months before somebody's seen the break even of paying that 4 grand at closing. So if somebody thinks they're going to have that mortgage for longer than 3.5 years, round numbers, then cool, pay the money today. And then you'll ultimately long term, after year 3.5, you'll start quote making money, right? The payment doesn't change, but that's when you've essentially paid yourself back for the 4 grand you paid at closing. So that's the math that you do to determine whether points are real or not real, but valid or not. I will tell you, in most cases, in today's environment, you're going to find that the points may take 3.5 years, may be a good scenario. I will tell you, it's more often going to be maybe a 5 year break even. And when rates are expected to come down, as they are at the time of this taping, expected to come down in the next 12 to 24 months, we do not necessarily recommend paying discount points, because we think, our belief is that when rates come down enough, it would be advantageous to refinance and get a new rate and a new mortgage. And so doing that, if somebody paid 4 grand and they refinanced a year from now, they only saved $100 a month. That was 4 grand wasted. They never saw the real benefit of that lower rate. So that's when you should and shouldn't pay a discount point. Is kind of just doing that math to see how long it is. Use your crystal ball, how long you have that mortgage. That ultimately determines whether you should or should not pay for a discount point. So a couple other random little things, not random, but other things, is that the nice part about discount points is they can be tax deductible. Talk to your CPA, depends on the type of home, depends on whether it's a purchase or a refinance. A whole lot of things go into it, but because it is perceived by the taxing authorities as being connected to the interest rate, right? So the money you're paying, that it can be deductible, right? So just check with your CPA. Again, refinances, they do it different than if it was a purchase, if it's an investment property versus a primary or second home. Again, those are the things that come into this, because they may depreciate it over a time period. So again, it can be tax deductible. Talk to your CPA, make sure you're doing that correctly, but that's certainly great. And like I said, lastly, there may be programs where you have to pay discount points. It's not an option. So again, post-COVID, investment properties, the way the market is, things like that, or maybe a credit score is something where it's like the rate just can't go high enough to eliminate a discount point. That may require the discount point at closing. So understand that sometimes you can avoid them and you do have the option, but just understand it's not always the case. So having said that, if you have any other questions, feel free to reach out to the Mortgage Mark team. We are here to help answer any and all questions. As always, when you think mortgage, think Mark.